Wagner here. It's approximately 11:30 in Honolulu, 4:30 in New York City on Thursday, the 9th day of February 2012, and this is the Daily Report for gold and silver. We do have the precious metals markets slightly lower to unchanged today. Interesting, gold was up about $10 in overnight trading, currently off about $2.5. As you can see, our current print, 1729.51. In silver, again, was up trading in the evening session and is now off by about 2 cents. As you can see, current print, 33.89.92 bid-ask spread. There was some reported news out of the European Union that there is some sort of a resolution or rescue package that has been tentatively approved for Greece to stave off the possibility of default as we get closer to our due date, March 20th, when they're supposed to come up with what I believe to be about 14.5 billion euros. That's not the big picture. The big picture is that if, in fact, they are unable to secure that and they would add those numbers to their existing debt, they would be in a scenario where there would be no way out of it. So it's critical that they do get this package underway. You can really see the indecisiveness in the market as we look at our daily chart. This, of course, is a daily chart in Henkin format. Henkin format simply meaning it's an average chart. And I want to pay attention to this activity that we've seen of recent. And what you'll see is this doji-like candle here. And these are all small-bodied candles, these last three. And that's following this really drastic down day that we had. So it appears to me, at least on a tentative basis, that really what we're witnessing is a base forming again in the market. And realize that when we consider this market and we're looking at a daily chart, we've had straight green candles, solid sells, all the way up to this interim high, this 1760 right in here. The market comes down, it tests just above 1700, below 1720, right in there. You can see these lows. And you can see that we are absolutely, at least in my opinion, forming some sort of a base here. I believe at this point that it will probably form a base and continue higher. We're still, of course, long. We are long in this market from 1580 right now. For those of you who have put stops in the market, your stops should be sitting below 1706 on a protective stop. This is basis the cash market. If you're in April gold, you're going to want to add to that so that if April gold is $4 higher, you would raise that stop to under 1710 and act according in that way. And as I said, that is our daily chart. Now, when we look at gold through the same format, the Henkin Ashi, but we look at this format, of course, in a 480-minute chart, it gives us, of course, a little bit more detail. So what we see is this is that top that it hit, of course, up around 1760. The market comes down, and as I said, it tests just above 1700 right in here. This is 1705. This is the reason I am putting our stops below, because I'm putting them below the 23% retracement level. That's where I derive that number from. And of course, that retracement is a Fibonacci retracement from the beginning of this rally, 1520, to the top, 1760, and then all I'm really doing is looking at the 23% level and saying, since it held there, a break below this would signal it's time to take profits. As long as it's trading above this, I'm looking for prices to head higher. Now, when we take a look at our next chart, really what I want to look at, this is a 720-minute chart. Again, this is our gold chart, but I've taken off the candlestick so we can focus in on the Elliott wave count. And as best as I can see it right now, my belief is that we are still in wave 1. This is an intermediate wave, of course. These are all intermediate counts. There would be a major above this. And the major count above this would put this at a major 3 right in here, Let me go ahead and change the color of that, trader, so we can see that just a little bit better. We would have a major 3 right in here. And then when the market came down, this would be our major 4 right here. And then we would, right now, we are in wave 1 of 5, intermediate, and we're in our major 5th wave. So, if in fact that count is correct, what we are looking at is this wave 1, a pretty decent correction on our intermediate 2, a solid gain on our impulse 3, another correction, and then we'll finish off this major move, this major 5th wave, with what I believe will be a spectacular 5th wave. Now, why do I say that? The reason I'm saying that is one thing that we have really noticed in gold more than any other markets is that this is the last intermediate 5th wave right in here, and you can see that that took the market from 1450 to just below 1920. Our record tops here, I believe that this was around 1913, 1915, somewhere in that area. But that's when you consider the kind of move we saw here. This 5th wave, which starts down here and ends up here, well, this was one tremendous move. And we can look historically, you'll see that in gold, it's been that 5th wave that really has propelled the markets to new highs. So that's why I think that the 5th wave could be the largest of the 3 impulse waves. Now, silver in the same way. We're trading sideways in the market. We're going to start, this is simply a daily chart. Go ahead and blow that up for us. It is in a straight candlestick format. Also, my current belief is that we're in an intermediate 1. We've just finished our major 4. It is following along with gold. And we've got some real resistance in the market, obviously. And that resistance is this 35-38 area. You can see right now it hasn't even been able to go back up and test it, but it's just trading just below that area here. But you can also see that the market is consolidating. It is choppy right now. One thing that I am not going to be surprised to see is a return of our volatility into the marketplace itself. We've seen that when you consider yesterday we had the market down $10, then up $10. This teeter-totter is what we can learn to expect. Now, I have gone ahead and converted it into a Henkin. You can see we are at green candles. There's no mistake about that. The candles are green. However, the candles are not the kind of candles we typically want to see for a strong uptrend. It's telling me that the trend isn't that strong. Why? Well, you've got these tails again, the lower tails. You notice how there's an absence when that market is really going strong. And an absence of the lower wick is simply saying that it opens above the midpoint of yesterday's close, because that's how they're fixing it. But these candles are green. I believe that just as in gold, we are forming a base, and that base we're forming will be followed by higher prices. At least that's my sense right now. Now, in terms of certain areas, this also is a daily chart, but we've put up a couple of different areas. You can see that this resistance, right now we've got a high of 34.49. And so what I've simply done is I have run 2 sets of Fibonacci sequences, and one set takes us from $44 all the way down to the low, and the second sequence starts at the low and takes us up to this high. And the reason for that is so that we can look at different areas of support here. 23%, 32.52, it needs to hold that. But as you can see, the 38% retracement level. Now, this is a retracement level, which is the longer of the retracements, meaning it takes into account this high and this low right in here, because that's where it's coming from. You can see that the market has on a couple of occasions tested it and found support in that area. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.